Hello traders, and welcome back to Explain the Charts. Today is November 17th, 2025, and we are taking an in-depth look at EURUSD, one of the most traded currency pairs in the world. First, let's cover the news and the overall market sentiment. Headlines are overwhelmingly pointing towards continued strength for the US dollar, which is putting significant bearish pressure on the euro. Reports from various outlets indicate that the medium-term outlook still favors the dollar, with many traders looking to sell any short-term rallies. This sentiment is largely driven by anticipation of key U.S. economic data, including a delayed jobs report, which could act as a major catalyst for the market. The consensus suggests that as long as the Federal Reserve's policy outlook remains hawkish compared to the European Central Bank, the path of least resistance for EURUSD is to the downside. Now, let's see how this bearish narrative is reflected in the price action on our charts. Looking at the daily chart, the story the news tells is crystal clear. We can see a powerful downtrend that has been in effect since the peak back in late June of this year, when the price was trading near the 1.18 level. Since then, we have seen a textbook series of lower highs and lower lows, which is the classic definition of a bear market. The sellers have been firmly in control for several months. A particularly important event happened on November 6th, where we see this massive bearish candle representing a drop of nearly 2%. This was a significant technical breakdown, as the price sliced through the key support level around 1.08 without any hesitation and on high volume. Following that breakdown, the selling pressure has continued, pushing the pair through the 1.07 and 1.06 levels. Currently, the price is attempting to find some stability just above the psychologically important 1.05 level. This recent price action establishes some very clear zones to watch. The most immediate support is the recent low established on November 14th around 1.0496. If that level breaks, we would look towards the yearly lows from January, which are down in the 1.01 to 1.02 range. On the upside, immediate resistance is now at the recently broken support levels. The 1.06 level and, more importantly, the 1.07 zone will likely act as a strong ceiling for any potential recovery attempts. Now let's switch to the 1-hour chart to examine the price action more closely. It's important to note a discrepancy in our data feeds for this video. The daily chart we just reviewed shows current prices around the 1.05 level. However, the most recent hourly and 15-minute data we have appears to be showing prices in the 1.15 to 1.16 range, which contradicts the daily chart's major drop. For our analysis, we will trust the daily chart for the major price levels, but we can still analyze the patterns on the shorter time frames to gauge recent market sentiment. Looking at this hourly data from late October, we can see a period of consolidation followed by a sharp breakdown on October 29th. Notice how price action tightened before a strong bearish push broke the support, demonstrating how intraday ranges can lead to volatile moves. This type of pattern is what traders look for on shorter time frames to signal a continuation of the larger trend. Moving to the 15-minute chart, we can analyze the most recent price structure up to the end of last week. Despite the price level discrepancy, the pattern here is one of sideways consolidation and chop. Over the past few days of trading, there has been no clear directional bias. The price is caught in a tight range, oscillating without making any significant higher highs or lower lows. This suggests a state of equilibrium or indecision in the market. This pattern is quite common after a large, trending move like the one we saw on the daily chart. The market is essentially pausing, digesting the recent losses, and waiting for a new catalyst to dictate the next direction. This lines up perfectly with the news that traders are awaiting key U.S. economic data before committing to new positions. So, let's bring it all together and recap what you should be looking for. Switching back to our primary daily chart, the dominant trend is undeniably bearish. The key support level to watch is the recent low around 1.05. A confirmed break and close below this level would signal a continuation of the downtrend, with the next major target being the 1.02 area. On the resistance side, Any bounce will likely face its first major test at the 1.06 to 1.07 zone. A break above 1.07 would be the first sign that the bears are losing control, but a true trend reversal would require a move back above the 1.09 resistance. Now for some potential scenarios. The highest probability scenario, which I would place at around 70%, is a bearish continuation. The trend, fundamentals, and sentiment are all aligned, suggesting a test and eventual break of the 1.05 support is the most likely path. A lower probability scenario, perhaps 20%, is continued consolidation between 1.05 and 1.07 as the market awaits fresh news. Finally, a bullish reversal is the least likely outcome at about 10% probability and would require a significant, unexpected fundamental shift, such as surprisingly weak U.S. economic data. Keep a very close eye on the upcoming U.S. jobs report. It will almost certainly be the catalyst for the next significant move. And that's our analysis of EURUSD for today. Please remember, this content is for informational and educational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own research and due diligence before making any investment decisions. Thank you for watching Explain the Charts, and don't forget to like, subscribe, and hit the notification bell for more content. Trade safe, and we'll see you in the next video.